Like there are many different types of charts, there are also many different time frames. And the reason for that is because we as traders, we want to be able to view historic price movement with more or less detail depending on our trading horizon. So if we want to place a long-term trade, we want to be able to see more historical context. And for this we use long-term charts. Whilst if we want to take a short-term trade, maybe an intraday trade, we want to be able to magnify the price action to reveal more detail short-term at the expense of the historical context, and vice versa. So time frames should be seen as lenses to use to look at information in the chart differently. And for us as traders, it's really important that we utilize these tools and lenses appropriately depending on our needs and the job that we need to do and that we want to do. So to take a real-life example, if you go out in the night and want to look at the night sky and the moon, you wouldn't bring a microscope with you. Instead, you will take a telescope. So you have to use the right tool for the job. And it's exactly the same way with trading timeframes. So one of the most important and fundamental ways to look at timeframes and to really fully understand them is to understand their relationship towards each other and when to apply which time frame and how to use them effectively. So if you look at this picture to the left, which is taken with an 18mm wide lens on the camera, you can see a lot of detail, right? You can see the lake, you can see trees on the right, you can see the clouds in the sky, and far back in the background you can see a mountain range. If you now look at the same scenery with a 55mm lens, you will see greater detail on the lake. You will see the ripples. You will see this mountain range has moved a lot closer. You can see more details of the mountain range, but you've lost some of the context in the picture, which is the trees on the right side. So you can see more detail, but at the expense of seeing less of the scenery. Looking at the last picture, which is a telephoto taken with a 200mm lens, here you all of a sudden can see a lot of detail on the mountain range, right? But you have completely lost view of the lake and of the trees on the right side and of most of the clouds in the sky. So now let me ask you this. Which one of these views is the right view? Which is the correct view of this scenery? Is it the one to the left? Is it one to the right? Or is it the one in the middle? The answer is simple. Neither one of them is the right view. It's the same scenery, you're just simply looking at it with different lenses. Greater detail to the right, less detail to the left, but more context. You see more of the scenery at the expense of less details, and to the right you have more details at the expense of less context. So just because in the right picture you can't see the lake or you can't see the trees on the right side, just because you can see them doesn't mean they are not there, right? Or in the left picture, just because you can see the snow on some of the mountaintops here, it doesn't mean it's not there, it's just simply you do not see it. So they coexist at the same time, it's simply that you're looking at the scenery differently. And exactly like this is how you need to think of price action on the weekly, daily, 4-hour, 1-hour chart, or any other time frame for that matter. Each time frame is its own lens and perspective about the price action, the order flow, and the history. So each time frame has its own trend and its own context. The key here is to pay attention to the time frames that's most relevant to how you want to trade. So for example, do you have a full-time job and you can only trade a few hours after work? Yeah, then you might look to trade the high time frames, right? But if you want to be more active trader, you're looking to capture short-term movements within daily price action, yeah, then you would use a lower time frame, an intraday time frame. So with that being said, let's have a look at the most common time frames. So the most commonly used time frames for swing trading, where you're looking to hold trades for days or maybe even weeks, would be the weekly time frame, the daily time frame, the 4-hour time frame, and occasionally also the 1-hour time frame, which allows you to refine your entries and find better trading locations. For day trading, it would be the 1 hour, 30-minute, 15-minute, 5-minute, 3-minute, or 1-minute chart. Where you would use, for example, the 1-hour chart for more historical context to establish the overall price action context and the direction. And then you would use, for example, the 5, 3, or 1-minute chart to initiate an intraday trade. Now, on top of these time frames, many brokers offer individually adjustable time frames, which means you can create custom time frames if you so want to. Meaning that you could have a 7-hour chart, meaning that each candlestick on the chart would be made up of 7 hours of price action. Or you could have a 18-minute time frame where each candle on the chart would be made up of 18 minutes of price action. But overall, the most commonly used time frames, and which we recommend you to start out with, are these time frames here shown in the screen. So going back to the picture we showed earlier of the scenery with the mountain and the lake, I thought we'd use them to have a look at the multi-time frame example of charts and to show you how the time frames relate to each other and how they work together. So here on the screen you can see a daily chart, which corresponds equally with the bigger scenery chart we showed you before. And if we want to view this context in greater detail, a portion of this context in greater detail, we could, for example, magnify an area here like this. So this red box, if we magnify this and look at this price action in the 4-hour chart, you can see that instead of each bar here being made up of 1 day of price action, because it's a daily chart, each candle here in the chart is made up of 4 hours of price action. And naturally, this means you have 6 candles per day. So each daily candle here is broken down into 6 individual candles, 4-hour candles. And naturally, this shows you this section of the context in greater detail, similar to when we zoomed in on the mountain range in the photos. Now you can take this a step further and you could look at this price action in the 4-hour chart on the 1-hour chart. So if we take out this portion of this 4-hour chart and look at it on the 1-hour chart, each 4-hour candle is then split into 4. So each candle here on the right side is 1 hour of price action. And as you can see, this reveals even more detail as the 4-hour chart. So similar to the third picture we showed you where we zoomed in completely on the mountain, this would correspond with, for example, in this example here, the 1-hour chart. But just because you only see this price action in this chart doesn't mean this context to the left does not exist. So they coexist. You're simply looking at this context here to the left in the daily chart with a greater magnification. So exactly the same as in the pictures. We're looking at this mountain here. That doesn't mean that there isn't a lake and that these trees here on the right side aren't there, right? So what we are simply doing is we are zooming in on this price action and looking at it at greater detail. So when we look at price action context, we never look at one chart or one time frame just in isolation. We always consider the context on multiple time frames and align them together, because like we just discussed, one chart doesn't reflect the truth of the price action context. All of them coexist at the same time, and thus it's very important that we also incorporate all of them into our price action analysis. So now that you start exploring charts, you start exploring and studying time frames, really take your time to explore this concept and to try and understand it. Because if you understand how time frames work together, it puts you way ahead and it will save you a lot of time and a lot of frustration, because this is where many aspiring traders get stuck. Just to give you another visual example of how the time frames work together, I thought we would look at candlesticks and again how they form. We've already discussed how one single candle forms, but what's interesting is, like I said, candlestick charts are one way for us to visualize price action, as there are many different chart types and many different ways to visualize it. So we have to treat it as the tool as it is, and we have also to understand how the time frames correlate to each other. So if you look here to the left, you have one daily candle, and how it forms we've already discussed. This daily candle, which is 1 day of price movement, can be broken down into 6 4-hour candles, which also represent 1 day of price movements. So all of these 6 4-hour candles formed this daily candle. So just to show you here, so this candle, the first 4-hour candle in this series, which is 6 times 4, it's 24 hours, 1 day of price action. It opened here where the daily candle opened, right? It moved within this price range, it closed up here. The next 4-hour candle opened up here, it moved within this price range, created the upper and lower wick, and it closed down here, so a bearish candle. And so it continues, open here, close up here, bullish candle. Open up here, move within this price range, close down here, bearish candle. This candle, the 5th 4-hour candle, there was not much change. And then you have the 6th and last candle, which opened down here, moved within this price range, and closed up here at the top, so a bullish candle. So if you now look here, which the first 4-hour candle in this series, the open of that candle was also the open of the daily candle. The lowest low of all these candles made in this series represents the lowest low of the daily candle, right? The last bar close up here represents the daily candle close, because it was the last bar in the series, right? It was 24 hours. So the trading day ended here, and the last 4-hour bar closed here. Thus, it's the same close price as the daily candle. And the highest high made in this entire series of 4-hour candles is up here, and that corresponds with the highest high of the daily candle.